the Fed eased after COVID, and whether that led to the inflation or not, and if the unwind with the Fed hikes will then reverse that.
Yeah, certainly part of the stimulative response to the supply side shocks and the overall weakness that came from COVID was, the Fed was certainly an important component of that. And the printing of money helped finance those fiscal deficits, those significant fiscal deficits, which put money in the hands of spenders and helps create the persistence in that inflationary dynamic. So that was certainly an important component of the story. I think what we're seeing now, I think we take a step back for those folks who haven't traded through the last 15 years or so. A big part of the story back, in 2009, 10, 11, 12 was, can the Fed do enough to stimulate the economy to get growth going? And the reason why that was a challenge is because interest rates were at zero, and the Fed was, printing money in order to stimulate asset prices, but it just wasn't enough to get the particularly the lower income quintiles to be able to pick up their spending, pick up their borrowing. And that makes sense because they weren't particularly sensitive to what happens in the equity markets. Well, I think in a lot of ways, what we're seeing today is a similar dynamic. It's just in the opposite direction, which is years of easy monetary policy has allowed basically anyone who has any debt to refinance it at, zero or very low, which means that they're not particularly sensitive to changes in the short end. Like corporate financing costs today, the change in corporate financing costs over the course of the last year has essentially been zero. Whereas if you went back to the 70s, because they borrowed much more on the short end, you saw big swings that were basically commensurate with what was going on with short-term interest rates. And so corporates are not sensitive to interest rate hikes. Households are not sensitive to interest rate hikes, to be clear, in the United States in particular. And so the result is, like, what's going on? Well, the Fed basically only has the asset price channel to use because the interest rates aren't really making much of a difference. And that asset price channel, I mean, first of all, hasn't been so effective. Like, S&P 500 today is above where it was when Powell started tightening. So, first of all, it's not working. And second of all, even if it was working, it's pretty slow moving. It's not a particularly effective tool. And so the Fed is kind of stuck in this position where they need to break that wage to spending to prices cycle. But the tools that they have at their disposal are not very good.
And so it sounds like your outlook is that inflation will remain quite high, in the 4.5%, 5%, 6% mark for the foreseeable future. Is that a fair characterization?
Well, I think, all of these things are on the margin. Like on the margin, the Fed tightening is doing a little something. The economy is slowing down a little bit. The labor markets are softening a tad, right? Yeah, like there is this glacial move that's going on in terms of bringing the economy, slowing down the economy. And so I'd be remiss to say, oh, well, the economy is basically where it was a year ago. Exactly. That's not really right. The question is more about going back to this sort of macroeconomic dynamic versus psychological phenomenon. The real question is, how do these things, there's a race going on, at least in the US context. And the race is between inflation being elevated for long enough that it becomes increasingly entrenched against the Fed's steps to slow down the economy. And so that's the race we're on.